Welcome to Talk Tickers. We know you're busy, so we're here to give you the shortcut to understanding important earnings calls.
That's right.
Today, it's US Bancorp. We're going to pull out the key details from their latest call, the numbers, the strategy, what you really need to know.
Think of it as the rapid download.
Exactly. So let's jump right in. What were the headline figures for this quarter?
Okay, so for Q1, US Bank reported earnings per share of $1.03.
Okay.
And their return on tangible common equity, or ROTCE, hit 17.5%. Pretty solid.
17.5, nice. Anything else stand out in the snapshot?
Yeah, something they highlighted was achieving positive operating leverage, 270 basis points, actually, on an adjusted year-over-year basis.
So revenue growth outpacing expense growth by 2.7%.
Exactly. That shows some good efficiency gains, and it's actually the third quarter in a row they've done that on an adjusted basis.
Okay, consistency there.
Right. And credit quality saw some modest improvement, too. The net charge-off ratio nudged down a little, and they kept building capital. Their CET1 ratio, that's the Common Equity Tier 1, climbed up to 10.8%.
10.8%. Okay, so strong capital base. So beyond those top-line numbers, when we dig a bit deeper, what did the new CEO really seem to be emphasizing strategically?
Well, they reaffirmed the medium-term targets that were already out there, but really zeroed in on three immediate priorities.
Which were?
First, keeping a really tight grip on expenses. That was clear.
Oh, okay, no surprise there.
Second, really pushing for organic growth, trying to generate more business from their existing operations. And third, a pretty significant transformation they're undertaking in their payments business.
Let's talk about that expense management first. It feels like we hear that a lot from banks right now. What's the story at US Bank?
It's definitely a continued focus. They've been actively working on costs since early 2024, and this marks, I think, 6 quarters straight of what they call adjusted expense discipline.
6 quarters.
Yeah. But what's made more interesting now is they mentioned investment spending is kind of stabilized, and it's shifting more towards things that will actually drive growth down the line. So not just cutting, but redirecting. They also talked about ongoing programs for sustainable productivity, better client service, that sort of thing. They even hinted that they have more levers if needed.
Right, if the revenue picture changes. Makes sense. Okay, shifting to how they make money fee-generating businesses. How big a piece of the pie is that, and how's it doing?
It's substantial. Fee income is about 41% of their total net revenue. So yeah, a big chunk.
Oh, yeah.
And the core parts like trust and investment management, capital markets, those seem to have good momentum.
Good.
They also mentioned that some headwinds they had before in consumer fees and also from selling their ATM cash provisioning business.
Yeah.
Those are starting to fade.
So that could help fee growth going forward.
That seems to be the implication, yeah. Should pave the way for stronger performance there.
Now, that payments business you mentioned as a priority sounds like it's getting a lot of focus. What's the strategy there? What's the engine?
Yeah, the idea seems to be building this really vibrant payments franchise that kind of anchors the whole client relationship.
Okay.
What's key is that it drives both fee income and net interest income. They mentioned having $42 billion in average loan balances tied to payments.
Interesting. So it's loans and fees.
Exactly.
Yeah.
And their loan growth there has apparently been keeping pace with or even beating the industry average. Total purchase volumes were huge, like $925 billion over the last 12 months.
Wow.
A particular focus seems to be on the more affluent customer segment. They mentioned products like Bank Smartly.
Right.
And they're actually taking some of those expense savings we talked about and plowing them back into scaling up sales, marketing, all the payments efforts.
Makes sense.
Yeah.
Where are they focusing those efforts?
2 areas highlighted were California, following the Union Bank acquisition integration.
Right. Big market.
And also their Elon franchise. That's the business that provides credit card services for, get this, over 1,200 other financial institutions.
1,200. Okay, that's a significant white label operation.
It really is. Big potential there.
What about the other side of payments, the merchant acquiring business? That's something US Bank is often known for. Any updates?
Yes, definitely. That's undergoing what they described as a multi-year transformation.
Okay.
3 main thrusts there. First, getting it better connected across the whole bank, less siloed. Second, sharpening the focus. They're concentrating on 5 specific industry verticals: retail services, travel, entertainment, and healthcare.
So specializing more.
Seems like it. And third, a big strategic shift towards a more tech-led operating model.
Tech-led, what does that mean in practice?
Well, they said over a third of their merchant processing revenue now comes from these tech-led solutions, and it's concentrated in those 5 target industries.
Okay, so it's already a significant part.
Apparently so. And as a little proof point, they mentioned they moved up to number 5 in the Nelson report for processing volume in 2025, so gaining some ground. Got it. Okay, let's switch back to the traditional banking side for a moment. Net interest income, net interest margin, the NIM. How did that look, and what are they expecting?
So NII, net interest income, came in at $4.12 billion for the quarter.
Okay.
And encouragingly, the net interest margin actually improved compared to the previous quarter.
Ah, good to see. What drove that?
They pointed to, well, solid overall performance, that expense discipline we keep mentioning, and just generally good balance sheet management.
Then looking ahead.
For Q2 2025, they're guiding for NII in the range of $4.1 to $4.2 billion. So it's kind of stable to slightly up.
And longer term, that margin target.
Yeah, the medium-term goal is to get that NIM above 3%. They think that's possible in probably 2026 or 2027.
Okay, and how do they get there?
Few things. A better asset mix, repricing of fixed-rate assets as they mature. They expect like $5-7 billion in loans and maybe $3 billion from the investment portfolio rolling off each quarter.
Okay.
And they figure that stuff can reprice maybe 150 to 200 basis points higher.
Significant uplift potential there. Potentially, yeah.
Yeah.
And also optimizing their funding mix, managing deposit costs and sources.
Right. Okay, what about the overall balance sheet? Deposits, loans, the investment portfolio, any big shifts?
Total average deposits actually decreased slightly, down to $57 billion.
Okay.
Average loans were up modestly, totaling $379 billion. And the investment portfolio was pretty flat at $171 billion.
Anything else notable on the balance sheet front?
They did mention they don't expect to cross the threshold into being a Category 2 bank before 2027.
Regulatory implications there. Good to know.
Yeah, affects capital requirements and such.
Okay, moving on from interest income. How did non-interest income look, and what about those non-interest expenses?
Non-interest income, so the fee side mainly, was up 5% year over year, came in at $2.8 billion.
Decent growth. What drove it?
Mostly that payments business again, and also trust and investment management fees.
Okay.
And for Q2, they're expecting that number to be around $2.9 billion. So continued growth.
And expenses?
Non-interest expense was $4.2 billion. Pretty stable with the last quarter. And they expect it to be $4.2 billion, or maybe even a bit lower in Q2.
Holding the line on costs.
It seems to be the plan.
All right, let's drill into credit quality and capital. Always crucial for banks. How are things looking there?
Credit metrics looked pretty good. Actually, improved slightly. The ratio of non-performing assets to loans and other real estate ticked down to 0.45%.
Okay, lower is better there.
Right. And the net charge-off ratio also improved a bit, down to 0.59%.
Also good. What about their cushion, the allowance for losses?
Allowance for credit losses totaled $7.9 billion. That works out to about 2.07% of their period-end loans.
So a solid reserve?
It seems reasonable. And back to capital, that CET1 ratio, as we said, up to 10.8%.
Right. Did they do any share buybacks?
They did. Completed $300 million in share repurchases in Q1.
Okay.
But they signaled the pace will probably stay modest for now. They're balancing building up capital towards their target with returning some to shareholders.
And what is that target?
Their target CET1, thinking about those potential future Category 2 requirements, is around 10%.
So they're already above that target on a current basis, but maybe building a buffer.
That seems to be the idea, yeah, building towards that future requirement level.
Okay. So wrapping up the guidance, what did they say overall for the full year 2025 and Q2 specifically?
For the full year, they're guiding for total net revenue growth of 3 to 5%.
Okay.
And importantly, that positive operating leverage, they expect it to be greater than 200 basis points for the full year.
So revenue growing at least 2% faster than expenses.
That's the goal.
Yeah.
And they expect at least 200 basis points of that positive leverage in Q2 as well.
Consistent theme. Any mention of external factors like tariffs or anything?
They said they're monitoring the tariff discussions, but their current guidance already factors in what they expect right now.
Got it. Anything else on the guidance or company structure?
Just a quick mention of moving towards a simpler management structure internally.
Okay. So we've covered a lot of ground. Let's try to synthesize this for listeners thinking about the investment context. What are the main signals you took away from this call?
Well, I think the big themes are, one, that relentless focus on expense management, driving efficiency, that's crystal clear.
Right.
But two, They're trying to pair that with accelerating organic growth, not just cutting costs. And the payments business, especially that merchant acquiring transformation, seems absolutely central to that growth story.
That feels like a key differentiator they're pushing.
It does. But, you have to remember their ability to hit those medium-term targets, the revenue growth, the 3% plus NM that's going to depend heavily on the macro environment, interest rates.
Sure, the usual caveats.
Exactly. And crucially, on their own execution of these strategies, it's a multi-year plan.
Execution risk is always there. What about capital?
Capital deployment, yeah. Watching how they balance buybacks versus growth investments as they get closer to that target CET1 will be interesting.
Yeah.
They signaled modest buybacks for now. And finally, their comments about consumer spending, seeing resilience, particularly in the more affluent segment, that gives you a little window into current economic trends, at least from their perspective.
Interesting point. Okay, time for our favorite segment. This is not financial advice. We take what we heard and spin out an outrageous but plausible trade idea. What have you cooked up based on US Bank's call?
All right, so thinking about US Bank's heavy lean into the affluent customer segment, combined with scaling that Elon payments platform across tons of other banks, plus the tech focus in merchant acquiring, especially in verticals like healthcare and travel.
Okay, connecting the dots.
Here's the idea. Maybe consider a long position in some niche cybersecurity firms, specifically ones that specialize in advanced data protection and fraud prevention, tailored for financial institutions that serve those high net worth, affluent clients.
So betting that US Bank's strategy, and potentially others following suit, will boost demand for that specific type of high-end security.
Exactly. As banks focus more on the unique risks and expectations of affluent customers using digital platforms, specialized security becomes more critical.
Okay, makes sense. How would you hedge that outrageous idea?
To hedge it, you could maybe consider a short position in more generalist cybersecurity companies, the ones that offer broader, maybe a less specialized solutions, and aren't as laser focused on the specific, complex needs of the high-end financial services sector.
Interesting. So long specialized financial cybersecurity, short generalist cybersecurity, plausible, definitely outrageous. Remember, folks, not financial advice.
Absolutely not. Just brainstorming.
All right, that wraps up our deep dive into the US Bancorp earnings call. We've pulled out the highlights, the strategy shifts, the key numbers to keep you informed.
Hopefully it gives you a clearer picture of where they are and where they might be heading.
As always, do your own homework, your own research before making any investment decisions. This is just information and context.
That's right.
What stood out to you in this deep dive? Any questions still lingering? Let us know. We always want to hear what you're thinking about and what we should tackle next.